Hey, it's Soleil, and this is episode 12 of the Red Pilled Orange Pill Investor. And there was exciting news. The Bitcoin ETFs were approved, but the pump did not exactly happen. Um, I initially I thought, okay, I mean, all of my stocks got completely wrecked. You can see Riot's down 27% over the week. I'll show the other ones too, but they're all fairly similar. And this this is not even really a problem unless you're using margin, which I I I do use margin, and apparently I did not allocate properly or estimate well how badly this could crash this soon. I wasn't sure that it would pump, and I thought it could crash, but this was a little bit more spectacularly than I thought. Initially, I thought that, well, maybe since they couldn't invest in Bitcoin directly, there was no spot ETF, that maybe these mining stocks and MicroStrategy were a proxy for investing in Bitcoin, and all of the people who owned these just started dumping them so that they could buy the spot ETFs. And maybe that is true, but then I started wondering if everyone was buying up this stuff because they were expecting a pump when the ETFs were approved. So all of the prices of these stocks was already, pricing in a pump, and then the pump never happened. And so now everyone is just, expecting it to pump, and it didn't. Maybe these people were buying, were a little over leveraged, and now they're getting all of their accounts are getting wrecked. But here's the thing. So if you're not using margin, this is never going to be a problem. So let's just take, for example. So I bought 100 shares of Riot for $17.73. Those are down massively, like what, a third, over a third, since I purchased it. And this is why you sell covered calls. So I just set one up. It's business as usual for me. So today I set up a covered call for next Friday with a $14 strike. Now, I've linked Adam in the Money YouTube videos in the past, and he is a little hesitant to sell a strike below your average cost, because now if the price pumps back to 17, I would be forced to sell at 14, and I would technically lose $3 a share. That doesn't bother me as much, because there's like an 80% chance it'll stay under here anyway. However, as he did, even as he described it, that's called bag holding. So when you buy shares of something and then the price crashes so far that you can't get premium, now you're just stuck holding it. You're just stuck holding the bag. And I never let myself get in a situation where I'm stuck holding the bag. If this dropped to $5 a share, obviously I'm not going to be happy about it, but to a certain extent, I won't give a shit, because I'll find a strike. It'll be $5.50 or $6, and I'll get some premium, and then I'll use that premium to buy more shares. Now, I'm way too close to my margin limit, so I didn't buy any extra shares. There just wasn't any room in there to do it. However, I still collected premium this week. So other people may have a different philosophy on that, and theirs may be correct. I don't really know. Some people will, I think Tasteworks calls it going up and out. So you could go out to like 42 days, and you could, let's see if you could even get something at 17. Yeah. So you could go out 42 days, and you could sell the 17 strike. Like, you're so paranoid, like, oh my God, I don't want to lose money. Some people, some research has shown that going out to 45 days is, let's see, that's 49 cents. You can go out 49 days and get 64 cents at 17. and then you could buy another five shares with it. But yeah, some people are too paranoid to lose money, but I am not too bothered. And some say that going out 45 days is the optimal strategy anyway. And so then after about 3 weeks or so, you would look to maybe buy this back for half the price. So maybe buy it back for 34 cents. And then maybe, who knows what Riot is doing at that time. Otherwise, you could, in 2 to 3 weeks, you could just go out another 45-ish days. But like I said, that doesn't really bother me. But this is the whole point. So let me just go back to my history on Riot. Where is all of the history? Here we go. There we go. That's August. That's too far. I think. Holy smokes. Okay, here we go. This is what I wanted. So, December 29th, bought 100 shares, paid $17.72. 91 cents for them. Immediately sold a covered call. That's fairly close to the money, and I prefer to do that because I get the biggest reduction to my cost basis. So I didn't pay $17.72 for this. Technically, if you want to look at it this way, I paid $16.72, $16.64. So my cost basis is $16.64. I had to buy it back for $2, so now it's $16.66. I sold this for $62, so now it's $16.04. Bought it back $16.05, and now I sold another covered call for $22. What was it? What did I don't even remember what I just said. $16.05. So like $15.83. So my cost basis here is $15.83. So if I end up having to sell, what the hell? Oh yeah. If I end up having to sell Riot for 14, I'm only losing like $1.80 a share. And that's just the way it goes. I mean, I would probably end up it doesn't work if you don't have additional money in your account to buy this contract back. But if it did pump to 16, I'd just pay the $200 and I'd keep my 100 shares, and then I would sell another covered call for 50 cents or whatever. And I would just, eventually it would average out to where, a bunch of times in a row, this will just stay under your strike. And then it'll just keep reducing your cost basis again. And it ends up working itself out. So what was the other one? Let's take a look at Mara. Oops. So I bought Mara. Yeah, I ended up with I have 400 shares now because I started out with 100. Sold some premium, and I didn't just sell premium to Mara. I've got a bunch of other stocks on this account. But when Mara pumped to 30, I was like, okay, I'm not buying Mara this high. So that's when I bought some of that Riot. So in this case, I'm to the good. And it kind of all just averages itself out. Would I prefer that Mara was still 30? Of course. But the fact that it's down 28% this week, it just doesn't matter in the long run. And it's funny, Stephen Mark Ryan on the Solving the Money Problem channel, he is an investor, and he likes to clown on short-term traders. And so I kind of consider myself an investor with a short-term trading strategy. This isn't day trading. I think in the book Trade the Trader, which is an excellent read, by the way, I think he describes day trading as basically you go to cash every day. So the market opens, you start trading, and then in some rare circumstances, you could hold some trades over to the next morning if you think they're going to go up over, after hours trading or something. But day traders, as far as I can tell, just go to cash every day. and then there's got to be something in between. So in between going to cash every day and just buy and hold, like SMR talks about, there's some middle strategies. And I prefer to hold things for the long term, but sell covered calls against them along the way. And again, the only reason that I got wrecked as badly as I did, as far, I ended up having to put a little extra money to cover some margin, which was annoying, but it's not the end of the world. I don't have any HUT right now, but let's just take a look at it anyway. HUT's down 15%. So if you do have, some cash, these are perfect times to either, buy 100 shares now at, for $1,000, and you can probably, I'm just going to guess you can get 7 or 8%, well, 5%. So you could sell, well, plus you're getting the 42 cents call away value. Let me see what selling a put on this would be. Yeah, 5%. 5 times 9? Yeah. You can get about 5% on HUT. I still don't like the bid-ask spread. But let's look at Riot. Go back and look at Riot again. Yeah, and Riot is almost as cheap as HUT. So why even bother doing HUT with poor liquidity? Oh, and HUT you can get way more premium, it looks like, anyway. You could get 5% premium at the $12 strike and 62 cents in call away value if you buy 100 shares at 11.38. So if I had kept some free buying power, this would have been a nice buying opportunity for me, but I just had to hold on for dear life to avoid margin this week. So yeah, that's how it works. You get in at wherever you get in, and then you sell covered calls every week to reduce your cost basis. And here, usually I'm a little bit more aggressive, but I went 14, which is a full, I think the price was 12 when I set that covered call up. So that's like $1.62 in call away value, which is over 10%. So if Riot pumps back 10% again, I picked a fairly reasonable strike here. I was only able to get, how much premium did I get? I only got 22 cents for it. But it just doesn't matter. You're just chipping away at the cost basis. So this, every time you sell a covered call in it, then your purchase price becomes lower and lower and eventually goes to zero, and I guess it will eventually go negative if you want to look at it that way. But yeah, so I knew some weird stuff could happen. I probably should have been a lot more cautious about how much margin, and that's probably the next thing that I need to study and get good at is margin. Robinhood will even say, like, it'll tell you what your margin, it'll be like right here, and it'll say your margin is medium safe, or your margin's getting a little too low. But as long as you have like more than 10% of your account's value as margin, which seems pretty low, they're like, you're safe, and then the price dips down. The price dips on your stocks 27%, and now you're getting a margin call. So don't get your accounts blown up. Options are already leveraged. I mean, every contract is 100 shares, so it's not like just buying one share of stock, or one share of 50 stocks, and now you're diversified. It's 100 shares of that stock, and when the price goes up or down, it can really move your account up and down pretty quickly. So definitely don't trade anything that you can't afford to lose, like going to the casino. They say don't gamble anything you can't afford to lose. Definitely spend within your account. And if you are the slightest bit squeamish or you don't have anything in reserve, um, you know, I've got some in case of emergency break glass funds that I can spend. So if you don't, then just don't fuck with margin, and make sure you live to fight another day. It's that saying again that I really like. Um, I think I can't remember the guy's name, but it was playing blackjack as a business. It was a guy who used to count cards, and he said it's better to get rich slowly than or make money slowly than lose it quickly, something along those lines. So be smart, and let's just take a look at some of this. I was really interested in ARK. Kathy Wood is the only institutional investor uh, research that I listen to. I really like her tech focus, and the only thing that I've ever heard her talk about that made me kind of give her a little side eye is when she talks about Ethereum as if it's just as legitimate of an asset as anything else. And the channels that I follow pretty much think of Ethereum as a scam, and definitely like a shit coin. And I think Safety and Moose even called it the mother asshole from which all shit coins emerge. And so I used to trade Ethereum big time, and let's put it this way: a lot of the altcoin trading that I did was profitable, but overall, it was definitely not the way to go. I would have way more I would have way more funds if I just didn't fuck around with altcoins at all. And I mean, the returns on Bitcoin are so, the ceiling is so high that there's just no point anyway, unless you just are 99% sure about what you're doing with the shit coins. By all means, go for it. But anytime they want to pull out the rug on you, they can. So, and anytime the SEC gave Bitcoin approval, but there's no way in hell that most of these anything that's proof of stake, as far as I'm concerned, they're all going to be considered securities by the SEC, which none of them are registered, so they're going to be deemed unregistered securities. So as far as I can tell, they're all fucked, and I avoid them with 10-foot pole. But I'm keeping an eye on this. As soon as options are available, it'll probably take a month or two, but as soon as options are available on ARK, I will be very interested. And I forget what some of the other ones are. Oh, somebody was HODL. That was the best name. And these all were very ho-hum openings. They just opened and then they kind of just, down, down, down. But I don't know anything about this company, but I just think they have the coolest ticker, HODL. BlackRock's, I forget what BlackRock's is. But I like Kathy Wood's research. I always watch her podcast, and as soon as options become available here, if there's a couple of percent premium that can be had every week, I will definitely be adding this to my list and start selling covered calls on it, and see if it's a better kind of steadier model than the mining companies, because the mining companies all have earnings calls that you have to be mindful of, and I don't think ETFs do. So I think that's, you could just, I usually try not to have a covered call over earnings, and that's just one less thing to worry about. I have forgotten sometimes. So I think that's it for today. Be careful with margin or you'll get blown up. But when your stock tanks, as far as I'm concerned, and I'm not a financial advisor, I have to say this every fucking video, but this is not financial advice, but what I just shrug it off. I really don't give a shit. And yeah, so, selling covered calls is not going to be like, oh my God, I'm going to get rich every week. However, as far as I can tell, as a long-term strategy, it's extremely viable, and you sacrifice a little bit of upside for a higher chance of success, and I'm happy with that. So until tomorrow, be good, y'all.